I'm back on the other side of the table, this time with Lee Lindley of Mercia Ventures. Lee, welcome to the show.
Thanks very much. Pleasure to be
Thank,
here.
and pleasure to have you. Thank you for joining us. Lee, I'm really keen to dive straight in. We are recording this on the 12th of March, 2024. The first question I always ask is, what's your view on the market right now? What are you seeing out there?
Thanks very much for having us. I might work to give you a little bit of background about Mercia Ventures and where we play in terms of the market. So we're a UK-based venture investor. We invested anyway for pre-seed, seed, and Series A. And kind of an initial equity investment for us is anywhere between that £1 and £10 million mark. So that's kind of where we are in our position in the market. And kind of life sciences and health tech is an area that we invest a lot in. We like to think we've got quite a good track record and good reputation in the market. So I think we did get to see quite a lot of what is out there in the market. And I think my initial view is that there's quite a lot of optimism and positivity in the life sciences and biotech space at the moment. Both in the US, the public markets, there's quite a lot of, IPOs that are being successfully launched and funded.
Yes.
Quite a lot of, large private late stage and early stage rounds are getting closed. And even outside of that, we're seeing quite a lot of really amazing science being developed and proven out now across the biotech and life sciences space. And I know a lot of that is facilitated by, the recent advances we've seen in computational power, generative AI, machine learning, advancements in next generation sequencing, single cell sequencing. Those sorts of things are really unlocking, innovative, therapeutics, platform tools and that sort of thing. So there's really lots of exciting things being built out there. And I think we're at that point now in kind of early 2024 where we're seeing a lot of the startups and the early stage businesses that had raised money during 2021, 2022, they're reaching the end of their runway.
Yeah.
And they are looking to raise the next round of funding. It's been 3 years. That's kind of a traditional amount of runway for a venture investment. And they are at the point of trying to raise that funding. And, it's no surprise to anyone that the investment dynamics now are, really different than what they were back in 2021 and 2022. I think valuations and risk tolerance in early stage venture has, whether it's right or wrong, it has come down quite significantly. And there's a number of good reasons for that. I mean, even fundamentally from a macro perspective, interest rates now, and I know a lot of startup founders maybe don't think about this, but interest rates now are 20 times higher than they were back in 2021.
Right.
So from an investment perspective, cost of capital's gone up. Everybody has to make a better return on their investment. And equally, if I'm an investor, I could just park my money in a money market fund somewhere and then between 5 and 7%, and that's completely risk-free. So
Yes.
there's a real balance of, risk reward dynamics and trying to earn a really decent amount in terms of returns on investment. And that's played out across the investment landscape, not only like the public listed entities, kind of, money market funds, exchange traded funds, but in the venture world and the hedge fund world as well. So we're feeling that as much as anyone. And so, unfortunately, money is no longer free, and kind of we have to be really quite discerning as venture investors in terms of what we invest in and try and get comfortable that we can deliver a risk adjusted return for our investors, because that is essentially what the main metric that venture investors are assessed on by our LPs and our shareholders. So I guess in general, I think, there's a load of great investment opportunities in the early stage biotech, life sciences market that we're seeing. And, some of the investment dynamics coming off the back of, raises from the COVID environment are making some fundraisers, some follow-on fundraisers in this market quite difficult to conclude. Whether that's through, the high valuations being raised in the last round, which investors can't reach at this point in time, or, honestly, in 2021, 2022, money was cheap, so burn could be really high. Could grow quite inefficiently. And nowadays, I think that model just doesn't just doesn't really work for investors anymore.
No, absolutely. So the valuations are down a bit. And I guess there's, as you say, those companies that are coming back to the market, I suppose you as an investor are looking at, okay, well, show me what you've done over the last.
Yeah, what have you achieved, and
Yeah.
how much have you spent to achieve that, and kind of how much does that move the needle in terms of pushing the company forward,
Mm.
de-risking where you are from whether a technical perspective or a commercial perspective, and yeah, kind of how what have you managed to achieve over the last 2 or 3 years, really.
And I suppose this is kind of the dynamic of there's always been really exciting science, in the UK and around Europe and things like that, right? The quality, as you say, based on some of the advances that have been made, the quality of innovation is always really high, but can you actually build a business around that? And can you build an engine that really delivers something that will create value? I guess that's becoming more the question rather than is the science good?
Yeah, I think so. And the fact that money isn't free and isn't cheap anymore, everyone, all of the value chain, all businesses are looking at how they're spending
Yeah.
the capital and the finance they've got. So really, I feel like companies and, the customers you're working with, whether that's a pharmaceutical partner or, or a biotech or whatever, they need to spend their funds wisely. So they want to invest in things that are really moving the needle from them and what's going to make a material impact to them and kind of their outcomes. Uh, so, fu- fu- fundamental science is amazing. And there's lots of businesses that I do love to invest in, like really brilliant science, but it has to be science which is solving a really clear problem and is really value additive, the kind of
Yeah.
up the value chain. Just because, people are having to be really rational on where they spend when their money at the minute.
Yeah, absolutely. It seems like, and this isn't me necessarily having the data on this is just sort of anecdotal, but it seems like things are starting to open up. It seems like there's more rounds getting over the line now, and a lot that have been in conversation for a long time that are getting closed. Do you think that's a sign of the market opening, or do you think it's maybe a sign that founders are starting to get what they need to do now, or in both? What's your view on how things are moving?
I think it is a little bit of both, to be
Mm.
honest. I personally kind of invested Series A, Series B stage. So I've seen the similar sorts of things that you, the anecdotal later stage, fundraisers getting over the line, the Series
Yeah.
C's, the Series D's, the IPOs. And that generally shows a bit of, in my view, the wider market is unlocking in terms of, because there's been quite a lot of stalemate. You know, investors aren't getting distributions, so there's less new money coming back down the value chain or kind of back into Series B, Series C rounds, and that kind of causes a bit of a roadblock, frankly, in terms of the businesses that we've got in our portfolio, Series A, Series B, wanting to approach, get a new investor involved if they've not managed to exit or kind of support, get their portfolios, companies to have external fundraisers, they then struggle to move those finances back down to the
Yes.
earlier stages. But I think from our perspective, you know, I think in the UK market, seed and Series A is a little bit more insulated. It's quite a nice contained ecosystem to some extent. And I think, again, anecdotally, based on what we're seeing, fundraisers at that stage have been closing and getting away,
Yeah.
in the UK ecosystem. But I would agree that we are getting to the point where founders and management teams are realizing that the market is a market, and someone can only decide that they'll invest at a valuation or invest in a certain set of terms that work for them.
Yeah.
And there might be, at the start, but there might be some misalignment, or it might not be kind of as high as the expectations as a management team came to market
Yeah.
expecting. But if you speak to 50 investors and 50 investors say, I really love what you're doing, but I'm really sorry, the return dynamics just don't work for me, or the risk
Mhm.
reward dynamics just don't work for me. Unfortunately, we would just kind of walk away and just
Yeah.
try and find another investment opportunity that does work for us. Even if we love the team, love the science, love the market, our job. I know it sounds a bit weird and a bit cold to say it sometimes, but my job genuinely is to provide a return for my investors. That's why I invest and develop, do a good job at that.
Yeah.
then, I don't know. And ultimately, I won't be in this job for very long. So I can love a team and an opportunity, but unless we can get kind of an investment deal done, we're not going to get there. And so I do think founders are coming to terms with that, and
Mm.
kind of we're on a longer term journey, and a fundraise at Series A might not be where you want to be, but if that supports the journey to Series B, C, and ultimately a great exit, then this time in 10 years down the line, this will be a story we laugh about or whatever. Kind of, we look back on it wasn't great, but no, we got there in the end.
Yeah, we made it through. And you kind of touched on it here, Lee, but obviously with that lens of, you've got to provide a return for your investors. Really interested in, because every investor is different on this, but really interested in sort of the key things in your decision-making process around that. How do you make that assessment? What do you look for in an investment? And how, I guess, how's that changed recently? And just really interested to get your lens on that.
Yeah. No, I kind of touched it before, but for me, this is probably a personal note, but I really get excited by novel game changing science. That's where I feel like it all starts for me. And science that can really have a material impact on people's lives. It's a very long time ago, but actually started my career in the NHS, right? And I then spent, 5 years doing corporate finance and M&A, where I was trying to, help to introduce new technologies, new care models to improve patients' lives. And, that's why I love life science and health tech, and biotech investments, because these things are really important. So I genuinely love like really game changing science that can help unlock, you
Yeah.
know, improvements for patients, patients' lives and people's outcomes. And, you know, um, so that's where I really start. And then, it's a bit of a BC trope, but that if you are sort of is something that is fundamental and kind of game changing, that naturally leads into quite a massive market opportunity. And that is, how the venture game works. If the science is really game changing, you're solving a huge problem, then that leads naturally into something that could deliver a venture style investment and a venture style return, whether that's, some funds need to see 10x return on their investment. Some, very early down, like to see a pathway to 100x investment. And again, that's quite common over in the States. We're a little bit less, if you were a little bit less ambitious in the UK, if you
Okay.
deliver a 10x, I think that'd be that quite nice sometimes. Yeah, so big market, kind of game changing science. And then I know venture investors do say a lot, this a lot, but for me, at Mercia Ventures, like the team really is important. So, the way how I take that, the way we come to market is we want to be forming enduring partnerships with the companies that we invest in. Uh, and we genuinely, whenever we make an investment, we do think we're on a journey here for 5, 7, 10 years.
Yes.
It's not something that you want to be making rash decisions on, and you want to be working with and alongside, a management team that, do have the right skill set and the expertise, and, they found a way to solve this big problem. But
Mhm.
it's probably more important that the team you're working with are collaborative, they're open to input, they're happy to receive support, and at times constructive challenge. And kind of what's and why that's important, and kind of what's great about the job as working in venture is that um, we get to see quite a lot of problems across our portfolio, and a lot of the problems are kind of similar in nature. And, we see maybe, I think Mercia, we've got, 400 early stage businesses across the wider Mercia portfolio. And the team where I sit, we've got 45, kind of within our specific fund. So in a lot of the startups encounter the same problems at different times in the journey. So we see, every 6 months, every 12 months, kind of, this is a problem we've seen before. And we want to be able to, speak to our founders and management teams, about kind of how we've seen those problems solved previously. As a founder, the first time you might encounter a problem such as how do I scale across into the US is when it's right in front of you, front and center of you, and it's, make or break for that next major, inflection point for your business. Um, And even though we don't expect, boards and management teams to, you know, to do what we say and take all our advice, but what we want is a kind of a collaborative relationship where people are all open to listening and kind of taking support from the board, not just as kind of the wider board when necessary, really.
Yeah.
And kind of where things are moving at the minute, I guess what has changed in terms of the kind of the more risk averse funding environment is we do like to see some sort of commercial traction or kind of that independent validation. I mean, that's all it is. Yeah, it's really nice to have if you can get it. It's not always essential. You kind of don't always need it if, you know, again, if the strength of the science is really clear and the problems being solved is really clear and kind of funding is required to prove out some of that validation kind of at pre-seed stage, then that's absolutely fine. And that can be a really exciting time to invest for us.
Yeah.
But some sort of validation is really useful. And I guess another angle on that is it's about being clear on what are the things that and the milestones you're going to achieve from this fundraise, and how do we know that that's sufficient to support the next round of funding, kind of the next stage of growth. And so, like I said, Series A investor, speak to a management team, figure out an opportunity, that Series A stage, and then going to achieve, I don't know, X, Y, Z. We'll run a clinical trial, or we'll form one commercial partnership, or we'll take an asset into preclinical stage, so whatever it is, it might be. And we're all working on the assumption there that that's going to be enough progress that then an external Series B investor with a big check is going to read a big check, going to come in and say, yeah, like with that, we'll lead the next round. What's really helpful at the minute is kind of having management teams speak to Series B investors as well, the Series A, just to test out with them. This is what we want to do with, the 3, 5, 10 million we're raising now. If we hit these milestones and then we come to you in 2.5, 3 years time, is that going to be sufficient for you to then, would you be interested in us as a Series B proposition? And if yes, that's great. If not, let's hear it now and let's revise that Series A plan, or management teams revise that Series A plan and milestones to build something that, the Series B funds are interested in.
Yeah, because I suppose from your point of view, you'd rather someone's coming to you going, actually, we're going to need 2 or 3 million more than we thought we were going to need because we need to get to here. If that's been, as you say, if that's been validated, do you see that a lot of the time it's kind of assumed the point that they need to get to for the next round?
By management teams?
Yeah.
Yeah. It's definitely, we're definitely seeing it less now. There's more, it's more independent validation going on and more wider competition. And some of that as well can come from the strength of the board you've got around you. So if you've got a really experienced chair who's been there, done that on a similar sort of journey, or you've got, a strong set of non-exec directors already, independent NEDs who've been on similar sorts of journeys. And, I've got that across a couple of the portfolio investments I personally made. They're active in the market. You can get quite a nice sense that way as well as to what needs to be achieved, but you just can't be kind of independent validation. And what's really great is if, speaking to a company and they say, these are the milestones that we're going to achieve from your 5 million investment at this point in time. We've validated these with, a number of Series B investors, and I can introduce you to those funds and you can speak to those investors directly. I'll reach out to them and independently have that conversation just so you can hear it from the horse's mouth, really. Yeah.
No, I can see that. And do you find that the later stage investors are typically quite willing to help if it's an interesting idea?
Yeah, absolutely. Yeah, it's great. It's great for them though. As venture investors, one of the 3 parts of our job, the sourcing opportunities, securing and winning the deal, and then then there's the actual value creation and helping that company to scale and grow. And isn't that quite a nice way for a later stage investor to build that pipeline? For something coming down the line 1, 2, 3 years time, is by just having a 30, 60-minute conversation with one of the earlier stage investors, which is invested in a more riskier time, because naturally Series B, you like to see things a bit more proven out. It's a little bit more de-risked. So it's mutually beneficial for us. It kind of just gives us um, a bit of validation that what the company wants to do is going to be seen as valuable. And equally for the Series B investor, they're hoping that company secure funding, which might get them across the chasm of the valley of death or something
Yeah.
like that. So yeah, it does kind of work quite well actually. And equally, I would open to be doing that for any sort of seed business that's thinking if they want to secure Series A funding, potentially from Mercia Ventures. I don't see any downside in me kind of
No,
providing that sort of input.
no. And as you say, the market may be very competitive at that point for the investor side, right? You've got kind of your pick of the bunch at the moment, but if you've been one of the 4 or 5 people who've gone, well, actually, if you get to this stage, I'd be really interested. You're probably one of the first 4 or 5 phone calls that CEO is going to make, right? And so I
Yeah,
guess you get that first look at the stuff that's coming further down. So yeah, that
yeah,
makes sense. Yeah.
yeah.
Um, any other particular? I'm always interested in the mistakes that you see, right? The common errors that you see people making when they're out, either out fundraising or in terms of sort of making that initial introduction and that kind of thing. So making the assumption of follow-on funding is one of them you've mentioned. And any others that you see people typically making that you'd highlight?
Yeah, yeah. And this might be a kind of a dynamic for kind of life science investors and kind of scientists founders is that often they're so ingrained within a problem or,
Mhm.
especially if something's like a spin out or something they've been working on since their PhD, they're often so in tune with the problem that they solve and it's just so clear and natural to them that often, because sometimes do a really bad job of articulating what the problem is they're solving and why it's such a big problem.
Yeah.
And it's not just a nice to have problem. This is a fundamental issue that's being faced by loads of interested parties. And if we can crack this, it will unlock X, Y, Z. And, and like I said, as an investor, we need to be really clear as kind of
Mm.
what is the problem that you are solving? Why is it fundamental in nature? Why is it, what we don't want to be invested in something that's actually what's kind of a nice to have for a
Right.
potential customer and a potential farmer partner. And, you And in this sort of environment, like I said before, where budgets are tight, the nice to haves never get, internalized. It's a fundamental thing. So I think solving the problem, articulating why it's a problem is really important and it shouldn't really be overlooked.
Yeah. Nice.
Another thing, and again, it comes back to the point around we want to invest in like management teams that we think we can work with and form great relationships with is sometimes some teams, some CEOs and founders don't get their wider team involved early enough.
Okay.
Often you go through, a pitch, a follow-up meeting, some more back and forth and maybe an in-person session or two. And a lot of that is just with the CEO or maybe the
Right.
CEO and the CFO. That's kind of as much as you get to see really before you're at a point where you kind of got to make an investment decision. And actually, we're trying to invest in a wider team. And obviously, we appreciate early stage companies not going to have hugely formed teams.
Yeah.
Not everyone's going to be really experienced. But, if you've got a VP of business development who's going to be really key to you driving, securing 1 or 2 early commercial contracts over the next 3 years,
Mm.
we'd love to meet them sooner in the process rather than later because we're going to be investing, quite a lot
Mm.
of our energy and kind of our hopes for success will rely on them. Similarly with with your CFO, if you've got a chair, we kind of really want to meet the wider team earlier, get comfortable with them, like see them perform and build confidence in kind of what they know, what they're working on and what kind of where they want to take the business.
Yeah.
Um, and again, I kind of touched on the point of testing the milestones. I think that
Mhm.
people haven't traditionally done that and they're doing that a lot more at the minute. But kind of what that then leads into as well is if you are kind of in an early stage life science or biotech journey, just having some sort of appreciation of what that full journey looks like over how many years and how much fun do you think you're going to need to raise and over how many rounds on that journey is that going to be quite important as well, and kind of communicating
Yeah.
that to investors. What we'd like to do is, because we're on this on the ride and we're in the journey alongside our management teams for as long as we can. But obviously, funds have they're on deployment limits. There's only so far we can go with the funds that we have in the management. You need to get your other funders and big parties involved. So, we kind of would need a sense that we're able to, lead a round, co-lead the next round, do our pro rata for 3, 4, 5 more rounds, and then ultimately kind of that investment decision makes a lot of sense for us. Um, and again, similarly, if it might be a journey where we can just fund it all on ourselves, so as a Series A, Series B, and you know,
Yeah.
that's the point where we think we'll exit. Again, that might be really interesting to me and kind of my investment committee. So understanding that dynamics, that's really great. And what you don't want to be either as a founded team, but from their perspective, or as a venture investor, is you don't really want any surprises as to where the journey is going to take you. But nobody wants, a venture investor thinking that there's one round and we're done, and we'll invest 5 million down and that's it, will be an exit. But actually, the CEOs have always thought, well, I think I'd like to take it to the States, so we'll do a Series B, and then probably we'll need to do a Series C to really hit, the high, no, the high watermark, and then we'll exit. And equally, as a CEO, you shouldn't want an investor on, as part of the cap table, invested in you, kind of might have a board seat, not fully aligned with your journey and your ambitions.
Yeah.
That line is really, really important. And I genuinely, I mean this, I would rather a CEO decline, the founding management team decline our offer of investment because they think we're misaligned, and it's going to not, I don't think what we want and what you want kind of, is joined up.
Absolutely.
I think I want to grow this business to be a $10 billion business. So my plan next is to raise a $100 million Series B from the States, and kind of, uh, kind of leave you behind sort of
Yeah.
thing. That's absolutely fine. I'd rather have that than rather us make an investment and then kind of, it just not be aligned, and suddenly, it just doesn't work for both parties. And like I said, we're really clear on it here that we are very collaborative and it is a partnership. Uh, and kind of, what works for a founded team might not work for us, but that is
Yeah.
absolutely fine.
Yeah. And it's interesting. We see this quite a lot actually in the work that we do as well, that the sort of next lot of milestones and the next lot of objectives is always really clear in these companies, because it's the proviso on which they've raised the last bit of money, and everybody's really, it typically, biotech companies, life science companies are really transparent on that, and they're really nailed down on that. But actually, a lot of them don't have that long term. Well, this is the next 3 phases of this, right? And of course, things can happen and you
Yeah.
can go in directions, but um, the best CEOs, particularly, and this is particularly the CEO's job, isn't it? Is that the best CEOs know this is where we think the end of the journey is going to be, and actually, it might not be there, but at least we know what direction we're heading in.
Yeah.
And we don't know exactly how to do all the technical stuff, but we know broadly what the journey is going to be. And it's interesting because if you don't do that, I think you bounce from round to round, and actually, instead of going in a straight line, you end up zigzagging into whatever the market wants at a given time.
Yeah.
Which changes along the way, right? And isn't always coherent with what you started out to do.
Yeah, exactly right. And again, it's quite a common refrain, and it's commonly accepted fact in venture circles that the plan we invest in is never the plan
Right. Yeah.
that will be delivered, whether for good or for bad, or things change, like you said. You've got a key milestone, a key study, a key clinical trial, which will unlock the next phase, and for whatever reason, results aren't as good as you hoped, or the commercial deal, which was a slam dunk, it just fell away at the last minute, and suddenly kind of plans have to change. And again, that is genuinely absolutely fine as investors. We expect that. That's kind
Yeah.
of par for the course is things are going to change. But I think that's why the alignment point is really, really, really important and really powerful, because as long as we're aligned on the journey, plans changing, it doesn't really matter. Like,
Yeah.
we're all aligned on the journey. If, we need, a follow-on funding because we're going to need an extra 6 or 12 months to collect the data we need to, to secure the Series B investment. I think things are going well. We're all aligned. We're all still pulling in the same direction. Then that's the perfect thing for your existing investors to do.
Yes.
You're hype, invest based on conviction, invest based on a plan. And as long as everyone's cited on that plan and, like I say, all aligned, then why wouldn't we continue to help that company grow?
Yeah, absolutely. Absolutely. And any other final pieces of advice you'd give, Lee, to those people who are out there trying to raise money right now?
Yeah. Well, if you're trying to raise money right now, I guess my first piece of advice is a bit outdated, but I'd always say start early. Like, start really early, start way earlier than you think you need. You know, lots of investors kind of have their position in the market, and there's things that we like to invest in, and there's things that we don't like to invest in. One of the things from Mercia Ventures that we don't invest in is, and unless it's something really exceptional, is a very pure play single asset therapeutic. Like, that's really tough for us as kind of where we sit in the market and kind of what the funds we have in the management and able to deploy is, that personally I invest out of VCT funds, and there's strictly is kind of how much a VCT investor can invest in a business. So a pure play therapeutic that's going to go phase 1 to phase 3 clinical trials just on one asset, which might fail at any point. That's quite tough for us.
Yeah.
But we do kind of like platform plays and kind of therapeutic platforms and things that support the development of therapeutics, life science tools, that sort of things. But investors have those sweet spots. So, do your research in terms of what sort of things is these funds invested in, kind of how much can they invest? Because, fundraising isn't easy, and you don't want to be spending your time as a CEO, as a management team, engaging with an investor who's never really going to get there. Then it's never going to be a good fit for them. So, and often some investors, they're not very good at saying no early because they don't want to offend, a management team. But ultimately, their investment committee is never going to go for it. So kind of trying to find that fit early on is really good. And make sure you connect with those investors early. Even when when I say start early, I mean, try and engage with investors 6-12 months out before you're even about to launch your fundraising round. And that has loads of benefits, If I meet a CEO knowing that and I've done this quite recently, I met a CEO knowing that, 6 months out from the fundraising round, and just have it from that point, get an early read on kind of what is the science, what is the technology, what are they working on, where do they want to get to, kind of what are you looking to achieve in the next 6 months before you come to market. Well, if I'm speaking to that management team every 2 or 3 months until they launch the Series A raise, and every time I see them, they say, "Oh yeah, we managed to achieve what we said we were going to achieve, 2 months ago. Just hired that chair that I said I wanted to get in." Suddenly, as an investor, I can see, God, this team got a track record of doing what they said they're going to do and hitting the milestones that they said they're going to hit. And so when you come to us and you present an investment plan, and it says we're going to achieve X, Y, Z, before I even start thinking about the investment, I already know I've seen got 6 or 12 months of you hitting milestones that you've set yourself, which is great. That gives a lot of reassurance to us as an investor that and this is a team that can get behind and kind of something's really exciting. And I guess the other thing, I would say at the current time, at this point in time, is just be open minded on terms of getting an investment over the line and raising money. One of the things that I try not to do, for example, is I try never to use the word deal, like, oh, I'll go out and do deals. And I don't think of the job I have as a venture investor as doing deals. That feels really transactional. That I spend time working in M&A and corporate finance. And, some investors are just purely transactional, whereas, I think, you know, I'm here kind of as a partner to help support these companies, through their growth as they scale up and make some great progress. But quite frankly, again, going back to the job as investors, if the deal dynamics don't work for an investor, then they're never going to not make you an offer. They'll
Yeah.
just, say, I'm really sorry, I can't meet, your expectations in terms of, I don't know, whatever the round dynamics are or the deal dynamics, like you're just not going to get there. But at some point, the deal dynamics and the investment dynamics will work for an investor. Uh, and so there might, and, as investors, we are aware kind of what's going on in the market at the minute, and it's not easy, and things have changed over the last couple of years. And again, the deal word, at some point you do get into the deal, and at some point you end up negotiating, and investors know about negotiating. We're open to negotiate. There's no kind of hard and fast rules, and you might be able to structure or get to an investment proposition that does work for everyone. So from a kind of a founders and a management team perspective, do be open-minded, fortunately or unfortunately, there's a market out there, and, the market will kind of give you a steer as to,
Yeah.
where we can get comfortable with. But, you know, maybe one or two, or the main headline term, maybe the valuation you're after doesn't quite work for the investors, but actually they can do something else and give something else in terms of the wider, the overall composition of the investment, or whatever that
Yeah.
does work. So no, just be open-minded, and, I might be making my job harder for myself, but be prepared and open to negotiate on things like,
Yeah. And I suppose from your side, you almost want to see that negotiation, right? Because I know from my point of view, when I've negotiated commercial agreements, if you make, if you put proposals together and there's no negotiation, you kind of go, okay, I could have maybe got a better deal.
yeah, yeah. And
Yeah.
again, making the job hard for myself.
Yeah. Yeah.
It's quite it's always, it is interesting, and, actually making it, once you've got you're in exclusivity, you're negotiating the heads of terms, or you're negotiating the legals. Often that can be quite tough,
Yeah.
in terms of, everyone's got their own things that are really important to them. And so, there's sometimes, it can take a bit of time to, get an investment sorted, to, really going back and forth in negotiations. But what is good about that is then, you're all on the same team after that. So
Mhm.
actually,
Yeah.
we've all worked quite hard to get a deal done. But then if I now be negotiating against or with, a CEO, and to get a good deal for everyone, if they're then negotiating with a big pharma partner, I'm not worried that they're going to give the family silver away. They're
Yeah.
going to do it, do a deal in that sense that works for the company, rather than just do quick deal to get a name. They can, because, oh, I'm working with XYZ. Actually, it's not a bad thing
No.
to have that sort of skill set, and not be afraid to negotiate.
Yeah, that makes sense. Buddy, I've got lots more questions, but unfortunately we're out of time. Thank you so much for joining us, and really useful. Thank you for sharing.
No problem at all. Thanks for having me.